Sometimes in life, you pick up a book and you read it, and it has a lasting impact on you many, many years after you put it down for the first time. And this book did that for me. One Up on Wall Street by Peter Lynch. Because without exaggeration, without this book, I don't think I would be where I am today, both in terms of my own personal investments and also in terms of my career journey in running the company I do now. And so what I'm going to do in this video is walk through the key principles that I took away from that book and I have applied not just for long-term investing, but also for my options portfolio as well. So this is actually a recording of a coaching call I've done with our private community. And so that's why we're going to be doing a Zoom screen share and I'm going to be answering questions throughout the call. And so I hope you enjoy it. And without further ado, let's get into it.
So I'm going to be covering my favorite investing book ever, One Up on Wall Street. Why it changed everything for me, and how it differs from some of the other books I read before and some of the books I've read since then. And how I've applied these principles with actual stock picks, because I think that's kind of the most important thing. So before I read One Up on Wall Street, One Up on Wall Street was not the first investing book I ever read. I was actually thinking about this last week and I was like, what was the first investing book I ever read? And I don't know if you can call it an investing book, but the first book about this world that I ever read was Liar's Poker by Michael Lewis. Anyone read Liar's Poker? Give me a 2 in the chat if you've read that book. I doubt very many of you will have. I have no idea why 15-year-old me wanted to read that book. Because it's not like a how-to book. It's weird because it's half memoir and then half sort of biographical look at Michael Milken, the junk bond king in the 80s. It's a weird book in how it's written. To be honest, I haven't read it in probably 15 years. Because I read it twice when I was young and I haven't read it since. Maybe I'll go back and reread it. But it was a weird first book. I'll tell you that much. And then of course I do the others. I do The Intelligent Investor. I read a few of the Little Book series. And the Little Book series is actually not bad at all. But The Intelligent Investor is obviously like one of the first that I read. And then I seem to remember reading like a pirated copy of Security Analysis as well. Don't tell Ben Graham I said that. Sorry, Ben Graham. Couldn't afford a £30 copy of Security Analysis as an 18-year-old. But that gave me a very, very skewed view of what investing was. Because, like I say, with The Intelligent Investor, it's a very useful book, but it's a terrible book to read early on in your investing journey. Because, I thought investing was purely a numbers-based discipline. I thought the answer was if you just find this stock with this PE ratio and then you buy, it's going to go up. That's what I thought the solution was to all of this. But we now know that that is not true. So I spent probably a couple of years just trying to find like the perfect formula, trying to find the perfect stock screener. And what did I do? I ended up relying on stock screeners and I bought a ton of stocks that in hindsight we would call value traps. If you're not familiar, a value trap is just a stock that's trading at a very low valuation, but has a low valuation for a reason because the company's going nowhere. And this especially applies to my British comrades here. In the UK, we have so many stocks that are trading at relatively low valuations, especially compared to the US market. But there is a reason for that. It's not uncommon to find a large cap company in the UK trading at 5 or 6 times earnings and paying an 8% dividend. The problem is the stock price just steadily declines year over year. So I bought a ton of stocks with a low PE ratio, and I found out that stocks with a low PE ratio usually have a low PE ratio for a reason. Ian says, who was your first broker? So it was TD, who then became Interactive Investor somewhere in 2016. I don't even know what TD stands for. Is TD Toronto Dominion? Is it the same company? Oh, David, believe me, I try and learn from my mistakes. But now I'm wondering, who on earth was TD? I think it's the same company as Toronto Dominion, which is a bank in Canada, but I'm not 100% sure now. This is way before the free trades and the trading 212s of the world, let me tell you that much. £14.95 to buy a stock. £14.95 to sell a stock. Plus, if you wanted to buy a stock in the US, you had to exchange the money on the broker's platform, get a garbage exchange rate. So by the time you actually made the purchase, you were probably down anywhere between 5 and 10%, just factoring in all the fees. It was not a fun time. But hey, then I bought this book. So I first read this book in 2014. God bless Peter Lynch. Let me tell you. So if you haven't read this book, I'm going to give you a primer as to who Peter Lynch is, first and foremost. Because he's not, massively famous anymore. But he was one of the sort of like celebrity investors in the 80s, 90s, and early 2000s. And for good reason. His fund, the Magellan Fund, which he managed for Fidelity, averaged 29.2% returns annually when he was running it. It outperformed the S&P in 11 of 13 years, and he grew the fund from $18 million of assets under management to $14 billion of assets under management. Almost 1,000x. He stepped away because he said he didn't feel like he could outperform running a fund that was that large. David, you know what? I've got a confession. I've never actually read Beating the Street. I've heard it's very similar though. I've heard there's a lot of overlap. Is that true? Or is it a different kind of book? Beating the Street is sequel's probably the wrong word. It's another book that he wrote. He wrote a third book called Learn to Earn. I haven't actually read that one either, but I have read One Up on Wall Street multiple times. The cool thing about Peter Lynch is he didn't just have one specialty. He actually had multiple types of big winners. He had a few big winners in turnaround plays. Ford, for example, Fannie Mae, General Public Utilities, 3 big turnaround winners. And then also in stocks that we would consider, looking back on them, high growth. So the 3 big ones there, Taco Bell, La Quinta, the hotel chain, Lowe's, the hardware store. It's funny now, we're looking back on it, like Lowe's was a growth company. Yes, Lowe's was a growth company. Massive, massive things. Oh, thanks, David. That's good to know. Too many details in Beating the Street. I'm kind of interested in that stuff, so maybe I'll get a copy. So Peter Lynch did it all. So I'm going to start with the most important principle of all, and kind of like the foundation of so much of what we do here, which is invest in what you know. Sounds obvious, right? But those of you who have had onboarding calls with me, and if you shared your portfolio with me, you know I always ask a question. Why did you buy that company? Oh, I don't know. But some guy on YouTube said it was a good idea. Okay, okay, that's fair. What does that company do? Oh, I don't know. I've got no idea actually. And the there's a great speech by Peter Lynch, it's on our YouTube channel, and he talks about how people will spend hours at the grocery store looking at two different types of lettuce. See which one's worth saving 25 cents on. But then they'll put 10 grand into something that they don't understand just because someone told them to. It's a really interesting way of the way people do it. And I think the quote from the book itself is if people spent as much time investing as they spent researching what kind of car to buy, everyone would be much richer. And this for me was the single biggest needle mover as an investor. Because this is becoming more and more apparent to me the older I get. But it's like stuff that I was already doing that worked, but I've now had it confirmed by someone else. Because up until this point, this is 2014, I had really only had two stocks that had done well for me, McDonald's and Starbucks. Oddly enough, two businesses I understood very well. I don't know what that says about me. But I never really put two and two together. And in the interim, I bought so many companies, I couldn't tell you what they did, but it came up on a stock screener. Oh, yeah, PE ratio is 4. Oh, yeah, it's going to work. And even since then, I would say almost all of my poor investments have been in industries I didn't truly understand. As David says, industries that were outside my circle of competence. And I think the best demonstration of this in terms of a very successful investment for me, but also the community at large, I think it's probably been the most successful investment in terms of number of people who profited from it in our community. These guys, Meta. In late 2022, the stock was beaten down. It was under $100 a share. What is it trading at today? David, tell me what it's trading at today. I think David actually has the chart tattooed on him of its rise from 100 to over 500. It's got to be more than 500. Someone else help me out here. What's Meta trading at today? $5.89. Wow. It was trading at 11 times earnings. By the way, it's only 25 times earnings today. That tells you something. So here was my thesis. I thought the market had totally discounted the value of WhatsApp to Meta's business. They didn't factor it in at all. This is a piece of software with 3 billion daily active users. It is the de facto communication app everywhere but the United States and also China. I should put China in there. So you've got, what is that? 6 billion people who are the potential user case. And I also said at the time, for a lot of people, this is a commerce app as well. And the thing is, I looked at the numbers, right? The narrative was that all these platforms were dying, that no one uses Facebook anymore. Oh, Instagram's dying. Everyone's going to TikTok. But the numbers never made sense. Because the numbers just kept going up. So, well, everyone I know is on Instagram. All the big businesses I know advertise on Instagram and Facebook. I use WhatsApp on a daily basis. Where's this dying company? And for so many people as well around the world, this is the internet. You may not know this, but in a lot of these countries where, home Wi-Fi networks are not particularly broad, but data connections, 4G, 5G, are how people access the internet. For a lot of these countries, Facebook, Instagram, WhatsApp doesn't even count towards your data allowance. So that to them is the internet. And so many people are onboarded to the internet as a whole through these platforms. And I'm like, and this company's trading like it's going out of business. I remember we looked at the time and Domino's Pizza was trading at double the valuation of Facebook. I was like, this is insanity. And I think I'm up 210% on my cost base, as though this was based on 560 as the price, so it's probably about like 215% now. So I'm not going to complain. Anyway, next principle. This is key. This is so, so key. And I think one of the things that really hammers this home. Ian, I would say that Starlink is bullish for these platforms because you still don't have to have somewhere to go on the internet, right? People aren't going to just drop off. Still going to use all these communication platforms. Buy the company, not the stock. There is no company on earth whose stock chart looks like this. Doesn't happen. Sure, if you zoom out, it may look vaguely like that. But what happens in reality is the curve looks like this. Every single company goes through tough times. You have to go through this. You have to go through this. You have to go through this. Stock prices are going to fluctuate. Your company will go down in price through no fault of its own. It's funny, I always get questions in the Discord and via email. Why is this stock down today? No one ever asked me. Why is this stock up today? It's like there's always has to be a reason why the company goes down. But when it goes up, it's because you were a genius and you bought it. That's why it goes up. And so what I learned from this is almost every great company has the chance to be a bargain at some point. If you're in this game for long enough, you will truly understand this. There's going to be companies that you thought were like overvalued for years and years and years, and eventually you will have the chance to acquire them. For me, the two biggest ones that tick these boxes were Mercado Libre and Nubank. Both of these were trading 40% off their all-time high when I first bought them. Mercado Libre was 65% off its all-time high. But you look at the numbers, they were both well-run, founder-led, mission-driven companies. And if you looked at the core metrics, they were improving quarter over quarter, year over year. But what happened? The narrative on tech stocks, tech adjacent stocks, was so overwhelmingly bearish that everything was down. And you're right, David. New had actually bottomed at that point and had been steadily climbing for a little bit. But if you didn't see the stock price at all, and all you did was look at the company fundamentals, you'd have thought this company went up from day one because the fundamentals had gone up from day one. And there's very, very few companies now where we look at their quarterly results and we just expect them to be fantastic. But these guys always smash it out of the park. Ever since I've owned both of these, they haven't had a bad quarter. Strength to strength. But hey, sometimes the stock price fluctuates. I think someone was asking in the Discord the other day, why is Nubank going down? Because sometimes stocks go down. It's run up 100% in the past year. Is it not allowed a down day or two? David, I love it. I love it. It was David. David sold off. He checked his portfolio. That's what happened. Third principle. This one's a little bit more nuanced. This took me a while. Understanding cyclical companies. Some companies and some industries are beholden, they are fixed to the economic cycle. There are times when consumers have a lot of money, and there are times when consumers do not have a lot of money. There are times when money is cheap to borrow. There are times when money is expensive to borrow. Some companies, they only do well in good times. Main example of this, consumer discretionary. It's in the name, discretionary. Travel stocks, retail stocks. When there's less money going around, there's less discretionary spending. Growth industries have tailwinds and continued earnings and revenue growth even in down cycles. We look at cybersecurity, for example. Clearly a growth industry. Sometimes, though, we see industries emerge and move away from being cyclical to being a growth industry. Can anyone tell me what industry this might be that I'm talking about? Any guesses? Brian has nailed it. Because I want to talk about semiconductors. Semiconductors for, I'd say, 25 years, maybe 30 years, you could argue, were a very cyclical industry. Then we have a bunch of conflating technological shifts which made them a growth industry. We had blockchain technology, we had cloud computing, we had smart devices, or the Internet of Things as it's known. And suddenly semiconductors went from being in maybe a dozen household items to basically everything you buy. So for me, it was 2017 when this penny really dropped, and that semis were now a growth industry and not a purely cyclical one. So what did I do? I bought semiconductor ETFs. You know, in hindsight, should I just have bought Nvidia and AMD? Yeah, but hindsight's 2020. And I'm not going to beat myself up for making a profitable investment. even if I could have made an even more profitable one. So I'm okay with that. But understanding this, because this also works the other way. I want to just go back to this slide. I think a really good example of this right now, there's a lot of debate on Airbnb. Is Airbnb a growth company? Should we value Airbnb like a tech stock? Or is Airbnb just another travel stock that is going to be beholden to economic cycles? They do well when there's money to go around. They do poorly when there's less money to go around. It's an interesting debate for sure. The fourth principle. Look for simple companies with predictable businesses. Once again, if you don't understand what a company does, don't invest in it. And as a derivative of that, the more complex the business is, the more likely you are to miss something in your research. So we've covered a few companies like this, famous companies that have done really, really well over the years. But their business model was just too complex for me to understand. This is also why I don't think banks are particularly good stocks. Traditional banks, at the very least. Because the level of financial competency you have to analyze a bank and analyze a bank's balance sheet is so much higher than you analyzing, for example, a SaaS company. And even understanding, for example, how some industries will always have tons of debt floating around. That in itself is more difficult to do from an analysis perspective than look at industries where most of the companies don't carry any debt whatsoever. So that in itself is important. David says, when you analyze banks, is it more of a book value thing? Yes and no. Book value is obviously a much more important metric when we're looking at banks. But it's not the only metric that we can use. Because as we saw in early 2023, when we had the regional banking crisis, we had banks that, they look good from a book value perspective. They look good from a, how sound are they perspective. But we didn't know who they were lending to. We didn't know the potential for a run on that particular bank. So that's why I don't like these complicated companies or these conglomerates with like 50 different lines of the business. And so I think a really good example of this is the automobile industry. Most automobile companies are pretty complex beasts to analyze. This one's not. This one's pretty simple, actually. They only make electric vehicles. They only make a handful of them. They tell us every single quarter how many vehicles were produced. They tell us every single quarter how many vehicles were sold. They break it down by the vehicles. And the entire thesis boils it down to this. It's the world's first vertically integrated car company. Vehicles, energy, charging, robotaxis. You're going to compare that to an ICE manufacturer who's got some electric vehicles, they've got some gas guzzlers, they've got this, they've got that, they've got factories all over the world, they've got parts coming from 57 different suppliers. They don't manufacture their own batteries. They have no charging infrastructure. They're being pulled in a million directions. Tesla has one sole focus. So it's a very simple company to actually analyze. You know, for example, we looked at Hermes a couple of weeks ago. I found Hermes very simple to analyze. What do they sell? Status. Where's most of their business coming from? Okay, I can tell. So the more I invest, the more I like these simple businesses. It's why I like SaaS companies a lot, because I find them inherently just very simple businesses to analyze. How many products have they got? Okay, cool. What percentage of their customers have more than a third of the products? What percentage of the customers have more than half? If a customer joins this year, how much do they spend next year? There's metrics for all of these. Whereas, you know, we looked at Starbucks last week. Starbucks is a more complex business to analyze. And then there's like levels to this. You know, you want to try and analyze Wells Fargo, or you want to try and analyze like a chemical conglomerate. It's difficult. It's why I go back and forth on Palantir a lot, because their business is pretty difficult to understand. Constellation Software, God, David, that was a nightmare. Even Berkshire Hathaway to a degree. But I would actually argue that Berkshire Hathaway has become a lot easier to analyze over the past decade. Because to me, it's like you're just buying Apple, but you're buying them at a better valuation. Like that's always been my thesis, right? And you have the smartest man running the show, better allocator of capital than I am. But yeah, I mean, it's a pretty simple thesis at the end of the day. And the more I do this, the simple theses, thesize. What's the word I'm looking for here? Theses. The simple theses are the best ones. So that's what I learned from Peter Lynch. Give me a 4 in the chat if you enjoyed this call, if this was useful.
If you enjoyed this video, then you'll probably like what I'm doing on March the 6th, which is a live training on how to invest in a volatile market environment. It's completely free. The Zoom link is going to be down below in the description. And yeah, hope to see you there.